Well, the rate rise cycle we've seen in the last couple of months is now putting real pressure on households. And going into 2024, another 6 months of tough economic pain is predicted before conditions start to improve. To give his views, CBA Chief Economist Stephen Halmarick joins me live. Stephen, great to see you. So what are we in store for the next 6 months?
Well, as you mentioned there, the first half of 2024, we think it's going to look pretty similar to 2023. Real household disposable income is declining. GDP per capita is contracting. As you mentioned, the effect of the interest rate hikes is continuing to flow through the balance sheet, the spending of many Australian households. And we think that's going to continue to be the case through the first half of next year. But the silver lining in all that is we think the slower economic growth will mean inflation will continue to decelerate through 2024. And we think that means that by September next year, the Reserve Bank can start lowering interest rates. And I think that's going to be welcome news to many Australians.
OK, so how does interest rates play out in 2024? Do you think we've got perhaps 1 or 2 more rises and then late next year we start to see those cuts made?
So our base case is no more rate hikes in this cycle. The near-term risk is potentially 1 more increase in February. And the really key data there is inflation numbers that come out towards the end of January. So that's the December quarter inflation. So the Reserve Bank's own forecast there is for an increase of 1% on the quarter. If it's a little bit above that, let's say 1.2%, which is what the September quarter number was, there's a risk of a February rate hike. But on our forecast, we think the Reserve Bank has done enough to get inflation back to target, in a reasonable time frame. And the next move in interest rates will be down rather than up.
Can't they just look through December inflation, Stephen? It's Christmas. Of course people spend.
Well, what we've seen in our own household spending insights data is November was particularly strong for spending. And that's in the last few years, that's been the case. The Black Friday, Cyber Monday sales. Yeah, that's right. People get out and about. And then December spending has actually been quite weak. So we'll be publishing our December spending data on the 15th of January. So that'll give us a really good indicator of whether the strength in November was offset by some softness in December, which I would expect to be the case.
Tell us about how economists like yourself and the RBA kind of look at the lag effect here. They warn about is already changing people's behaviour now. So how does that affect their decision making in a couple of months' time?
Well, that's a good point. So there's big lags involved here. From the day the Reserve Bank puts interest rates up to the day people actually pay that higher interest rate on their mortgage can be up to 3 months. So the November rate hike doesn't start having an impact until February next year. So the Reserve Bank needs to take that into account. As we do with our forecast, they will do the same. And then, of course, there's the ongoing effect of the previous rate hikes. People are adjusting to the fact that their mortgage is costing more. The rent is costing more. And that's going to be an ongoing process through the first half of next year.
So no rate rises. Let's hope that you're correct, and I absolutely think you are, Stephen. But we're seeing the United States. They're about 6 months ahead of us. Is that a good indication?
Well, so the big change there is the US Federal Reserve last week. In their own what they call the dot plot, so the members of the US Federal Reserve expecting interest rates to be down 3 times next year, so 75 basis points and further rate cuts in 2025. So we actually think the US Fed will start lowering interest rates in May next year. And other major central banks, Canada, New Zealand, the UK, Europe, we're expecting all of those central banks to be cutting interest rates next year as well. So the interest rate increases that we've seen here have clearly been part of a global development, and the interest rate cuts we're expecting in Australia next year will be the same, part of a global trend.
Does that mean they've overcooked it?
Well, so we're all looking for the soft landing, the narrow path.
Yeah.
And I actually think there's a good chance that here in Australia we're going to achieve that. We'll get inflation back to target by the end of next year, or very close to, without the economy going into recession. So it's definitely a slower growth environment, more modest growth. but we're not forecasting a recession. So if we can get that narrow path, that'll be a pretty good outcome.
Well, that's some pretty good Christmas news, I reckon, Stephen. Thanks so much for bringing that to us just a couple of days before Christmas, and have a lovely one with your family.
My pleasure. Thank you. Same to you.